Good afternoon. Welcome to Rivers Capital Management Investment Committee discussion about the markets, how we're positioned, and what we think is going to happen to the markets going forward. Looking back, it's been a pretty good few years for Rivers. Last month in FT Advisor, our balanced portfolio was near the top of the rankings yet again, and that's despite our fairly defensive positioning that we've held really since the middle of last year. We've been concerned about the AI trade. I think the way that we would describe it is being more focused on the consequences of AI than the actual hyperscalers that are the mainframe. We've probably been a bit in error about that, but what's for certain is we would not be buying them at these levels. Whether we should have held them is open to debate, but the performance of the portfolios has been encouraging. So I'm going to talk to Eduardo, who's head of our investment committee, about our current positioning, which out of a risk level of 1 to 7, with 7 being the most aggressive and 1 being the most cautious, we've been at what we call a 2. 4 is neutral. We've been at a risk level 2 across the portfolios since October last year, and the performance has been strong. But without further ado, a few questions for Eduardo. What's your current position in the market? What do you see as the biggest risks to the portfolio right now, given our position?
Well, I think there are a number of factors and indicators at play right now. I think the AI and SpaceX IPOs could be an interesting turning point, and I think everyone is focused on that generally. So that's an indicator, and when those are behind us, I think people will then reflect away from them. They're almost a distraction now. I think seasonally we've reached a point of the year where generally the summer months see softness, and you've had a lot of insider selling in a lot of the sectors outside of the defensive sector, which we happen to have overweighted now, which is healthcare. That's shown the highest amount of insider buying. Most other sectors have showed insider selling. You've also have a situation where not only mega cap and AI tech is now significantly overvalued and has had a good run, but also some of the more defensive sectors have had good runs, and I would say possibly we touched on precious metals, for example. That's becoming a little more sensitive to interest rates being higher for longer, so they could be vulnerable. It's a smallish sector, but nevertheless, energy, oil and gas have had a big run with the Iran-Iraq war, something we've also had an exposure to. But again, it may have reached a point where the risk has become such that any resolution in the Middle East creates volatility, and therefore it's no longer an overlooked sector. When we were looking at it, when we looked at it, frankly, no one was interested in oil and gas. It was very cheap, and it was sort of on its knees. It's the sort of things that we look into when we think any kind of catalyst can spark a rally in that sector, which it did do. It's now fairly well overhauled. I wouldn't say it's discounting everything, but it is discounted certainly a lot more than when we first bought it. So I think there are a number of factors now market-wise which we look at, which point to more downside risk in the medium term, and not a lot of upside reward. And that's why we're positioned where we're positioned. And I think it's the right one, certainly for the next few months.
In terms of that, I mean, I get slightly worried about the fact that oil has been high. We've got to $120 or something. There was quite a big scare in April, but since then, despite the Strait of Hormuz not in any way been open. There seems to have been a drawdown in Chinese inventory. Not a great massive drawdown. They haven't been building, I think is probably more of a way to describe what Chinese have been doing. But there's been a big drawdown in Europe and America. But it doesn't seem to have affected the price of oil. I mean, we're nowhere near where we were in 2008 even, which is 16 years ago. What do you account? What do you think accounts for that? I mean, why hasn't oil gone any higher?
That's a good question. I mean, there might be, you probably need to ask an oil trader that and get a better answer than I can give. I suspect the factors that you pointed out, which there was a significant inventory glut. And this last few months has been a big drawdown in that. I think the Exxon Mobil, or was it Conoco, CEO made an interesting point that inventories are now dangerously low. So those inventories have now been drawn. And I suspect the United States position was, or the administration's position was, the inventories are sufficient to temper the effect of this conflict and the closure of the straits for a time. The question is that we're running out of time now, and as you said, China can afford to. China generally does when there are spikes in commodity prices. It's quite good at managing, being a centrally managed economy. It's pretty good at managing what it buys and when, and it's actually pretty good at buying things when they're priced quite low and not buying things when they're high. And so all these things have had a factor, but they will reach a point where it's that they run out and it's not sustained, and then the oil price will then have its move. So either it's resolved or it isn't, and if it isn't, the oil, and which is why we still have this exposure, right? Because the exposure is the right one to have, because there is a danger that it goes on longer than the US administration said it was going to go.
On a slightly different factor, obviously the jobs number in the US on Friday was one of the catalysts that caused the correction, and it was, as I understand it, a belief that interest rates that have been expected to be cut aren't likely to be cut. What do you think is driving the jobs renaissance, if you like? I mean, it's quite an extraordinary jobs number that came out. I mean, maybe quite a lot of them are related to the World Cup, but is the chance of recession in the US gone? What's your take?
Yeah, good question. So the correction was definitely last week an interest rate driven one, and a chap who I learned quite a lot from, who's now dead, in the investment industry, I said, what drives markets? And he said interest rates, interest rates, and interest rates. That was the first thing I thought about last week when it happened, and because finally it was driving markets again, and because it sort of hasn't really. We've had such a weird interest rate scenario for the last 10 years. Markets have kind of done whatever they wanted to do, and people haven't talked about interest rates that much, other than the fact that they were zero. So yes, and it was telling that precious metals fell quite significantly that day as well, and so gold again became an interest rate sensitive commodity, as opposed to a fiscal deficit sensitive commodity, which it has been in the last few years. And of course, highly valued equities, at least in the past, have always been rather negatively correlated to interest rates. So interest rates go up, these things tend to go down quite a lot. So I thought it was interesting that happened. And it seems to me that the market that is wakening up to the fact that interest rates are not going to go down for a while, because the inflation numbers are where they are. They're not going down. They may go up. And if the jobs numbers are right, at least, even if it is the World Cup, at least in the medium term, that is what is going to preoccupy market minds. And therefore, the market might be vulnerable in the medium term. That might all change because in a few months' time, maybe interest rates need to be cut because there is a looming recession. I suspect not, but right now that is not the case.
I mean, this is the conflict, isn't it? There's the concern about oil prices and whether or not that they can continue to go up if there's no resolution. So that's it, at least in the short term, inflationary, and in the long term, probably recessionary. You've got AI, which is clearly transformational for most businesses, but the valuations of the AI businesses have frightened us for a long time. They seem to have just been getting higher. You've got SpaceX, which is at least pretending to be an AI company, Anthropic and OpenAI raising billions, hundreds of billions, say, on the market at valuations of in the trillions. These are the concerns that we've been talking about and why we're at an underweight position in risk. Where could we be wrong? What's the potential? I mean, how good does things have to get for the valuations in these markets to be justified?
Being underweight risk, the way we can be wrong is if equities generally don't actually correct very much, but there's sector rotation and whatever, and that's kind of what we bet on to a degree, or we don't bet on. We allocate to sectors which we think are undervalued and underowned, but there's a reason why they're undervalued and underowned, and there are catalysts why they may not be. Energy was one, precious metals was another, uranium was another, healthcare is another, and I think could be quite a good one. Relative to the S&P, it's been absolutely awful, and it's reasonably valued compared to its past history, and there's a huge amount of insider buying, so the people actually in the industry have quite a lot of confidence in their own businesses. These are pretty good indicators for us.
And healthcare is likely to be quite a beneficiary of AI. And I think
correct.
The as you said, picks and shovels, but also the beneficiaries of AI may not be the providers of the AI and the investors in the hundreds of billions of pounds of, and that's our take. And I think that's the position that we've got, which is to be involved in AI, but not in the hyperscalers or the mega cap, the headline makers, but to be involved in where we see a kind of asymmetric return. There isn't so much downside, and there's still quite a lot of upside, which kind of fits with our process, right?
Exactly.
So that's probably enough chit chat. I was told last week we were too long anyway, but it was good. I mean, so on our scale of 1 to 7, 4 being neutral across the portfolios, we remain at a 2. We look forward, not that we would ever want the market to be down, but we look forward to there being opportunities to add risk, better valuations. But
indeed,
got any questions or got any comments on our attempt at these videos, please do let us know. Look forward to hearing from you. Thanks a lot, Eduardo.
Thank you.